Welcome to The Explainer. Today, we're going to take a master architect's approach to conquering the high-stakes world of commercial real estate financing. If you've ever wanted to structure and place multi-million-dollar transactions with the exact same rigor that lenders bring to their credit assessments, you are absolutely in the right place. So, let's dive right in.
You know, it's funny. A lot of people think that most massive real estate deals fall apart simply because the interest rate was too high or the lender fees were just too steep. But the counterintuitive truth of the matter, deals actually don't fail on price.
The reality, transactions collapse because the debt structure was fatally flawed from day one. That means pitching the wrong type of lender at the wrong stage, sitting in the completely wrong position in the capital stack, or bringing a borrower presentation that just begs for credit questions you aren't prepared to answer. In this arena, vagueness is severely penalized.
To make sure we help you avoid all those traps, we're walking through a highly structured playbook today. Phase 1, the foundation. Phase 2, pitching lenders. Phase 3, closing the deal. And we'll wrap it all up with the golden rule.
All right, Phase 1, the foundation. Look inward before you look outward.
This phase is all about looking in the mirror. Before you even think about picking up the phone to call a lender, you have to nail down exactly what this financing is actually supposed to achieve. Are we talking an acquisition, a refinance, maybe a speculative development? Because let me tell you, each of those carries a wildly different risk profile. Once you've got that, you evaluate your income and debt serviceability, and finally lock in your capital requirements and target loan-to-value ratio. Honestly, treating this like a rigorous structured sequence instead of just, grabbing a casual coffee with a banker, that's exactly what separates the heavy hitters from the amateurs.
And speaking of that evaluation, we have to talk about the ultimate reality check for your asset, the debt service coverage ratio, or DSCR. Look, lenders underwrite cash flow first and asset value second, period. They want absolute proof that the property's income can comfortably, and I mean comfortably, cover the debt. You've got to play devil's advocate with your rent roll and tenant credit quality way before a lender ever gets their hands on it.
To put some hard numbers to that, most senior lenders are looking for a minimum DSCR somewhere between 1.20x and 1.30x during their underwriting. And here's the thing, if you're fuzzy on the details regarding your lease expiries or void rates, the credit process is going to ruthlessly expose those blind spots. And usually, it happens right when you think you've already got the deal in the bag.
Okay, moving on to the second vital metric you absolutely have to establish, your target loan-to-value, or LTV. This ratio is basically your roadmap. It tells you which lending channels are actually realistic for your project and exactly how much of your own equity you're going to need to bring to the table. You want to map out any potential funding gaps right now, long before the clock starts ticking and that pressure to close really ramps up.
Just for a little context, if we're looking at senior secured loans in the UK and European markets, you're typically hovering around that 50 to 65% LTV mark for stabilized assets. So, if there's any daylight at all between those senior debt proceeds and the capital you actually need, you've got to spot that shortfall today. Trust me, the absolute last thing you want is to be deep in negotiations and suddenly realize, oh wait, I need a whole extra layer of mezzanine debt just to make this work? That brings us right into Phase 2, pitching lenders, taking your structured deal to the market.
So now we're pivoting from internal prep to outward strategy, steps 4, 5, and 6. This is where you map out your capital stack, put together an absolute bulletproof borrower presentation, and run a tightly structured, highly targeted lender process. Because listen, how you package this deal directly dictates the terms you're going to get. A lender's very first impression isn't just about the brick-and-mortar asset. It's heavily influenced by the sheer quality of your presentation.
When you're building out that capital stack, think of it like a layered cake. You start with the senior secured debt right at the base, then move up through your mezzanine or preferred equity, all the way up to the common equity at the very top. Every single slice has its own unique risk and security profile. Getting this structure right before you ever engage a lender? Totally non-negotiable. Because the second you sit down, institutional lenders are going to ask who's holding those junior positions, and they'll want to know for sure if an intercreditor agreement is already locked in.
Now, once your stack is built, the big question is, who are you actually pitching to in the 2026 landscape? Well, in one corner, you've got your mainstream clearing banks. Right now, their appetite is pretty constrained. They're dealing with strict regulatory capital requirements, and they're very cycle-sensitive, especially with central banks pointing to commercial real estate as a systemic exposure. But then, in the other corner, you have private credit funds. These guys are hungry. Their appetite is massively expanding, and they are aggressively stepping into the gaps left by traditional banks. But, and this is a massive but, they demand a highly disciplined approach.
Let's actually break down what they're looking for. If you're going after private credit right now, you have to proactively answer 4 very specific concerns. First up, exit clarity. They aren't underwriting to the entry, they're underwriting to the exit. Number 2, sponsor quality. They are judging you, the sponsor, just as hard as they're judging the asset. Frankly, a weak sponsor attached to a stellar asset is still going to get hit with restrictive covenants. Third is asset liquidity. Basically, how fast can they offload this thing if everything goes south? And finally, debt yield. They are looking for a hard floor above 7%, and that is completely independent of your cap rate assumptions. Your pitch needs to hit every single one of these points head-on.
Which leads us to Phase 3, closing the deal. The high-stakes sprint to the finish line.
Okay, I really need to give you a heads up here. Getting a term sheet signed is not the finish line. It's actually just the start of the real battle. A term sheet is a negotiating document, guys. It's not a final binding offer. Steps 7, 8, and 9 are going to require you to aggressively negotiate those terms, survive a grueling due diligence process, and then actually execute and manage the debt. The ink you put on the paper right here dictates your legal reality for years.
Pushing a deal across the finish line is frankly just a sequence of intense friction. You sign the term sheet in week 1, and then boom, you're plunging into a month or more of hardcore lender due diligence. We're talking structural surveys, environmental assessments, valuations, the whole shebang. Now, a meticulously prepared data room can speed this up a lot, but the real trap, that springs after week 7, years 1 through 5. Execution has to instantly pivot into active, ongoing debt management. Borrowers who treat their reporting and covenant compliance like an afterthought, they're the ones who end up having very uncomfortable, forced conversations with their lenders, usually right when their negotiating position is at its absolute weakest.
Finally, we arrive at the golden rule. Think of this as the ultimate Jedi mind trick of commercial real estate financing.
Here it is, the master secret behind this entire playbook. The most bulletproof commercial real estate financing structures are always built backwards from the repayment event. The absolute best borrowers in the business know exactly how the lender is getting their money back, whether that's through a sale, a refinance, or an income sweep, before they ever even say hello to a banker. When you completely understand how a lender views exit risk before that first meeting, you are walking into the room with an immense amount of power.
So as we wrap up this explainer, I want to leave you with a question to chew on. Take a hard look at your current projects. Are you actually building your debt backwards from the exit? Try applying this master architect approach to your next multi-million-dollar transaction. Prepare the foundation, structure the pitch, anticipate the exit, and just watch how much smoother your path to closing actually becomes. Thanks for exploring this with us.